give me your understanding of the context we are in right now, both from a global standpoint, because that is heightened uncertainty, and a domestic standpoint where there are certain expectations that are being built heading into the budget.
From a market point of view, they are expecting Triveni Sangam in the budget. One, maintain the path of fiscal prudence. Honorable Finance Minister guided 4.5% fiscal deficit for FY26 while presenting the budget. That must be honored. Second, the private capex is low and urban consumption is subdued. Both of them require some sort of fiscal push or support. The government this year announced budget spending of about 11,111 crore on the capex. One, please ensure that the target is achieved and ensure that in next year we spend similar or more kind of money on capex. Urban consumption can be supported either through subvention in EMI so that leveraged consumers can get benefit, or through some tax concession at the bottom end of the middle class. Finally, if you are going to spend money and maintain path of fiscal prudence, you need to raise resources. Now, as Chanakya mentioned, taxes should be collected as bee collects honey from the flower. The salaried class and people who are already in the tax net are probably taxed at a much higher rate. Time is to look for improving compliance so that people who are outside of tax net starts paying fair share of tax. Unfortunately, in India, we still have people who believe that if they pay taxes, it will go to Queen Victoria. They need to remember that we got independence on 15th August 1947. If we can do this Triveni Sangam of fiscal prudence, capex spending and urban consumption boost, and raising resources through better compliance, I think this budget will go a long way in supporting India's growth.
At the current juncture, also taking into account the prospects for gold, the opportunities in fixed income at a time when the interest rates might be heading lower, what is the kind of allocation that you think is appropriate?
So, Alex, we have been always advocating asset allocation to our investors. Yesterday also we advocated the same. Today also we are saying the same, and tomorrow also we are going to say the same. Our view is that interest rates will be cut. RBI yesterday increased liquidity through Triveni Sangam of open market operation, repo and buy-sell swap. That sets the stage for interest rates to come down. So in fixed income, go for duration. Gold, we remain bullish as there is competition between Indian housewives and central banks around the world who will buy the maximum gold. And I believe now central banks have converted to Indian housewives, whereby once they buy gold, they don't sell. Gold should get supported by central bank buying. On equity side, our view is that this is fair value market. With correction, it has become little fairer. And hence, this is time to be neutral weight to equity with some bias towards large cap. Now, many investors and distributors haven't raised, the correction issue in recent times. But there are commentary outside. People who are not mutual fund investors are jumping far more about how investors have lost money. I just did a quick calculation, Alex, by Kotak Emerging Equities, our mid-cap fund. 5-year return of that is about 24% and 1-year return is 21%. This is when the world is crying that mid-caps and small caps have corrected massively. You are getting 24% return compounded for last 5 years. What more does one want? So people will have to ignore correction because you have made massive wealth in last 4 or 5 years. Be happy with that return. Markets will go up and down. It is your asset allocation which will deliver return to you.